Welcome to Stock Cheat Sheets, where we trend, rank, and grade stocks and exchange traded funds.
It's Mike O'Connor and Cole Hartman. Stockcheatsheets.substack.com. God, that's so hard for me to say. I was for 14 years ChakinPowerUser.com, and so I feel disloyal. I've switched my loyalties, but we built cheat sheets as a sort of a lower cost data platform for either newer traders or people with accounts that really can't justify big high-end solutions like Chaikin. Listen, Cheat Sheets is not going to replace Chaikin Analytics. Cheat Sheets, though, is a very reliable system for quickly evaluating and ranking stocks and ETFs. And the way we use it in these videos is we can use ETFs that represent different market indexes around the world and different styles of indexes like commodities and US large caps and global indexes to really paint a picture of what's going on in the world. Because Cole, who's learning how to trade, he's basically got his Robinhood account and does not have a big enough. What do you have? Like a few grand in there, something like that?
About $1,000.
Yeah. So he's a college kid, very interested in trading, starting out. And he's going to decide how deep he wants to go down the rabbit hole. And Cheat Sheets is the kind of the starter data package. It's, listen, it's mostly free. And I don't even recommend paying for it until you know what you're doing. And then if you want the deeper dive and get trading signals on individual stocks in the S&P 500 and the small cap index and dividend payers and some commodities and some disruptive tech ETFs, then, it's $5 a month. So it's cheap no matter what. So if you only have, a $2,000, $3,000, $4,000, $5,000 account, having a $50 data source against that makes sense. What doesn't make sense is a $2,000 data source. Chaikin is the Cadillac, but unless you've got, $50,000 to $100,000 or more to put to work in the market, it's kind of overkill for the amount of capital you have to trade. All right. So Cole, we always start with, before we worry about individual trades, we got to get a sense of what's going on with the market. So we're going to go through what's called a top-down analysis. Have you heard that expression before?
I have heard it, yes.
Yeah. So top-down analysis is basically a way for us to use cheat sheet stacks to figure out what our bias is, whether we're bullish or bearish, what the market is likely to do in the near, intermediate, and long term, and then we want to be trading in the direction of the market. Now, Cheat Sheets is granted a bullish trading data source. I don't have it set up yet for bears, although bears would probably know how to use some of the indicators to set up short positions. And I, in fact, probably would say that right now is a good time to be doing some short positions. So we'll look at the one of the stacks that I got ready for today's meeting is the ultra short ETF stack. So it's basically takes indexes that are short, but you're trading them bullishly. So they go up $1 when the market goes down $1. All right. So it's a way for people who aren't comfortable with borrowing stock to short it or to buy puts, that's an option technique where you basically make money when a security goes down. The short cheat sheet stack gives you a way to trade bullishly, even though what you're really trading is a bearish thesis, if that makes sense. It's called an inverse ETF. All right, so let's take a look at what's going on in the market. This is as of the close overnight, and the market opened about a half hour ago, so things will have moved a little bit. But it's always it's good to get a sense of where we're headed. And so, Cole, just stop me if you have any questions as we look through this, okay?
Sounds good.
All right. Can you see my screen? You should be seeing kind of a bugle-ish like trading pattern. You see that with the SPY in the lower left-hand corner?
Yep.
All right. So this is basically, as of last night, where we're at in the market. So what happened is we had this big-ass summer rally. It started in June, and it lasted a couple of months, and it got torpedoed by the Fed last Friday at Jackson Hole. Right here, we started heading lower.
Oh wait, hold on. I think you're on the wrong screen. Sorry, I'm on the pre-market playbook.
Oh yeah. It's not moving. Let me try to figure. Let's see if I can figure that out. Oh, you know what? I have to advance the slides in here. What did you know?
Okay. There we go.
Okay,
Yeah.
that makes it actually easier. All right. Thank you. All right. So here it is. And let's see if I can get us a little bit better layout here. Let's see. If I do that, there we go. Less of us, more of the charts. All right. So this is the S&P 500. The ETF is the SPY that represents it. It's sort of where we start because this is where kind of the U.S. large caps, this is where your Apples, your Microsofts, your Amazons, all the big U.S. companies, which most people are interested in, are all aggregated here. And this is basically a snapshot of the market. And as you can see, what direction have we gone in the last week or two?
Downwards.
Yep, downwards. And are you familiar with what happened last week at Jackson Hole when Jerome Powell, the head of the central bank, the Federal Reserve, gave a big speech about interest rates? You might have heard about it in the news.
I'm not sure. Did he say they're going to continue to raise them?
Yeah, he basically slapped the market around. And so the market was assuming that there's been a kind of an onslaught of bearish economic data lately that is suggesting that the economy is slowing down and that the inflation metrics that had been so concerning this spring have really tempered as economic conditions are getting tighter. People are spending less, they're driving less. The price of fuel has come way down. You know, I don't know about you, but where I drive, where I pay to fill up my car, I'm down almost $2 from where I was in May. So it's a lot cheaper to drive today than it was 2 months ago.
Yeah, definitely.
And all of that isn't because we've suddenly found more oil and figured out our way around Vladimir Putin's global extortion plan. No, it's the fact that the economy seems to be slowing down. And when that happens, people cut back on everything: eating out, buying stuff, driving. You know, you start to pare back to the essentials. And that's been what's happening. And that's called demand destruction. And it is a theme going on right now where you basically have one group of market participants that believe the problem is that the prices are rising at an alarming rate. People are getting raises too fast. It's hard to find people to fill jobs, so companies are having to pay a lot more. And so that's an inflationary force on the market. You've heard the term inflation before, I'm sure. So inflation is something that is like a stealth tax. The fact is that $3,000 to $5,000 you've been, had in your Robinhood account, assuming you haven't invested it, it's lost about 10% of its buying power in the last year because the cost of general goods, meaning what a dollar can buy today, is 10% less than what it could have bought a year ago. And so inflation is something that central banks and countries take very seriously because it can lower the standard of living of a population almost overnight. So there's one group that's basically thinking that the Fed has to do whatever it takes to tamp down inflation. And their tool is raising interest rates, among other things, and lowering the money supply. Have you taken money in banking or econ 2 or anything like that?
Yeah, I've taken monetary policy.
Yep. So you're familiar with M1, M2, and basically when you take liquidity out of the system and you tighten financial conditions, it gets harder for companies to borrow, right?
Right.
And when companies can't borrow as much, they can't grow, they can't do merger deals. When money gets more expensive, even the federal government has to allocate more of its budget to debt service. So it slows everything down. And in general, when the Fed starts getting aggressive with rate increases, housing prices come down. And that's kind of the number one thing that Americans see as a source of personal wealth is the value of their house. And houses just exploded over the 2 years during the pandemic, and now they're starting to soften. And then the other big one is the labor market. And the labor market is, I think there's still like a few million jobs that are unfilled open. I mean, you picked a pretty good time to graduate.
Yeah.
You should be able to get a good job unless the Fed torpedoes the economy, which is the concern. And that's the other half of what market participants are feeling right now. There's a whole nother group that says, Fed, you're too late. Why are you trying to slow down the economy? It's crashing. You are basically giving steroids to the wrong patient. That's the market argument that's going on right now. And last Friday, Jerome Powell gave a speech where he very clearly put to rest the idea that the Fed would start easing off the gas pedal a little bit and be a little bit more accommodative when it comes to fiscal policy, monetary policy, sorry. So he disabused the market of that notion. And as a result, we accelerated to the downside. And we've done a lot of selling here. So short term, we're under what I'd call a short-term oversold condition. But the overall direction of the market in the long-term time frame, meaning we're making lower highs, lower lows, lower highs, lower lows. But also after this rip-roaring bear market rally to the upside in the shorter-term time horizon, we're also headed down. So it's kind of a double down here. Mm-hmm. And this is a technical pattern called a bugle. It's a very rare technical pattern. It's where the highs that you connect and the lows that you connect sort of widen out like a megaphone or a bugle.
Okay.
And when that happens, that is a bearish price pattern, and you can extrapolate where prices are likely headed as this pattern matures. And so the first thing to know is that it's very likely that price will eventually hit the downslope here, which means that we're probably due for another several hundred points of downside on the market, SPY. And then what's troubling about a bugle pattern is then once it kind of hits its feet on the lower descending diagonal line here, you can actually measure the difference between in the widest point of the bugle and tack that on to the end of this and come up with a price target that's that much lower. So basically we could, let's pretend that the market is going to sell off to here, and then it breaks out of this pattern. You can actually measure the distance between here and wherever it breaks out, and then tack that on to the end and extrapolate a lower price target, which would put us in pretty serious trouble, right? That would be almost like an Armageddon market case. Yeah. But that's what this price pattern is saying. So it's something to take seriously, that the market is very much in danger of a significant down move just based on the technicals. Okay. And technicals don't really tell you anything about individual company stocks. They mostly tell you about human behavior, and they don't always work. And they're only as good as the information that people are acting on right now. So it's never a guarantee that it's happening. But we traders, we like technical analysis because everyone follows it. And when they follow it, it means we can come up with key little inflection points to make our directional bets. You see that? Like, you probably have a pretty good sense that if the market were to wind its way back up to this diagonal downtrending top line here, my guess is that you probably think about maybe entering short, anticipating the fact that if price gets back up to this diagonal line, it's more likely than not going to roll over again, right? You can make money to the downside.
Right.
And so traders are always looking for inflection points. And so part of cheat sheets is we're using some oscillators to try to as leading indicators to try to anticipate where listen, you're a lacrosse player, right? Mm-hmm. My guess is that you need to get open, right? And so you're often going to where you think somebody is more likely to pass the ball to you, right? So you can take it into the net and score.
Correct.
Right? So that's what this is. You got to get open and anticipate one kind of move ahead of where the action is currently. And you're a forward, right? You play what I'm not that familiar with lax, so you have to forgive me, but your athletic experience is going to be very helpful to you in trading. Mm-hmm. So when you set up a play, my guess is you practice a ton, right? Mm-hmm. And then what's the basic strategy as you're moving downfield? What are you constantly trying to do in order to give yourself an edge over the other people? Just in lacrosse terms.
In lacrosse terms, I guess we're trying to, be one step ahead of the defense in terms of the way we're moving. So trying to get open where they're not and be one step ahead of them. Yeah.
So that's what we want to try to do here. Okay. So there's a couple of closely watched moving averages. My guess is you'll have these on Robinhood. These are the most watched 2 moving averages on the planet, especially on the SPY, which is the most liquid ETF. The 50-day simple moving average and the 200-day simple moving average. The longer time frame is in green.
Okay.
Shorter time frame is in blue. And it tells you a lot about the market. Like, one thing we know is that when that blue line, that 50-day moving average, crosses under the 200-day moving average. Oh, stock market is just opening now. That's called a death cross. And it is the generally accepted signal that transitions us from bullish thinking to bearish thinking. So you can see that occurred way back in late winter, February.
You see bullish to bearish?
Yep. So when blue crosses green, that is the 50-day moving average crosses under the 200-day moving average. We call that a death cross. And a lot of traders believe just stay out of the market for as long as the 50 is under the 200. They keep things really simple and say, why do I want to be invested down here? Just wait for these moving averages to cross back over again. Sometimes it can take years. Sometimes you can get whipped in and out of trades. It's not foolproof, but a lot of traders will just do that. You're risk on, you're investing bullishly when the blue line is above the green line, and you're out of the market, not trading bullishly when the blue line is under the green line. So we had that death cross several months ago. By the way, the opposite is true when you have the blue line crossing above the green line. It's called a golden cross, and it is the most widely accepted signal that a new bull market has arrived. Now, sometimes these moving averages fake you out. They'll cross over and then fail. But more often than not, that crossover signal is the simplest and easiest thing to trade. And sometimes simple and easy in trading actually works the best. Okay.
And are these usually just pertaining to the S&P 500?
No, the 200-day and the 50-day moving average for any liquid instrument. And that's what's important. Okay. So these moving averages get respected because most institutions, the ones that have millions of shares under their control, they make the market, right? You and I with our petty, our tiny little accounts, we're little minnows.
Yep.
But Goldman Sachs trading desk or the big retirement funds like state pensions or college endowments, big institutions that have hundreds of millions of dollars at their disposal to buy tens of millions of shares. They drive the market. And so it is their activity, which is often based on, from a timing perspective, these technical signals. And the lowest common denominator with technical signals, the more reliable they are. But you have to have highly traded instruments. So more obscure pink sheet stocks or penny stocks that are kind of under most people's radar, they wouldn't all of these moving average, death cross, golden cross signals I'm sharing with you, they're less reliable. So you need a highly liquid market, and you want to be trading liquid markets, Cole. There's a lot of bad stuff that happens when you're kind of trading by yourself with with not too many other market participants in or out of the trade with you. That can create instability of price, and your stop losses don't work as well. And you just want a liquid market. It's really important. And so one of the things on your Robinhood trading platform is you should set as a rule for you, especially first starting out. Try not to trade any stocks that, have less than, $100,000 average share volume. 100,000 share volume in a typical trading day. Okay. And honestly, 1 million shares is maybe even a better minimum to start with. So it'll keep you out a lot of small stuff, and that may be something that's kind of disappointing to you because you want to kind of find that newest, coolest, new emerging company that nobody knows about, and that can get you into trouble because liquidity can wipe out a really good bullish theme that's based on fundamentals. So keep in mind, you want a lot of volume behind your equities. So think Ford, General Motors, Amazon, Meta, big companies, Coca-Cola, Pepsi, Kellogg's, things that you're really familiar with that have a lot of trading volume behind them. All right. So the market is in a downtrend. Now, price, as you can see, breached the 50-day moving average yesterday, but we had sort of a little tell that suggests maybe the downward motion, at least temporarily, is going to slow down. So I'm going to actually move to the trading platform itself so you can see this better, and we can take a look at how the market opened today. Okay. So what I'm going to do is I'm going to take this off, and I'm going to add our my screen here, and you should be able to see it. Okay, tell me if you can see my trading screen.
Yep, I can see it.
Okay, so I'm going to dial up the SPY here, and that's exactly what happened. So yesterday we had a bit of a reversal candle. So just underneath so we broke down below the 50-day moving average pretty clearly here. You can see that. Okay. Now, what will often happen is when a major technical support level, and I would consider the 50 a pretty good technical support level, when that gets breached, generally speaking, there's a fight between bulls and bears, and we're seeing that play out now. A lot of times what will happen is after a breakdown, there'll be what's called a throwback retest. You're going to hear that a lot in the world of trading, all about retesting broken support, which will tend to act as new resistance. And that's what we'll likely see today. So for some short traders are basically, as a result of this up move today, we're opening up 0.5 percentage point, where the S&P's, the SPY is up $2. And the SPX, which is the index that tracks S&P 500, the actual index will be up about 22. All right. And so it is retesting the 50-period moving average. Now, if it's successful and it breaks back above the 50, there's a good chance the market will trade sideways for a while, because these are major inflection points. And I'm actually rooting for that. I hope that happens, because it means it will slow down this crash. So that's one scenario, is price actually gets back above the 50 for a while, because we're a little bit oversold. And then we trade sideways, bouncing up and down off of the 200-day moving average and the 50-day moving average for a while. The other scenario, and probably the one that's more likely, is price is going to curl back up, which it's done, and you'll see that it hits its head on this 50-day moving average, and probably after Labor Day, it'll roll over and start trading down again. So that's called it's called a breakdown when it goes this way, when a major support area, meaning an inflection point, one where the stock has changed direction numerous times. And again, you'll notice that there's a line here. I haven't drawn it very well, but there's a couple of touches here, here, and here. And there you can see we touched it again here, right? So this lower area would represent an area of recent support where it used to act as resistance, then it acted as support here. And now it's come back down after breaking through this level. And we hit our head here and broken resistance. Well, we didn't break resistance. Sorry, resistance held. We've traded down. We broke through the 50, and we'll either retake the 50 or we won't, and we'll roll over. But we are at an inflection point right now. And there's definitely some traders, me included, that would probably like to take advantage of this up move. But you'll find in bear markets, price moves really quickly, and all of us have either day jobs or you got classes to take. So it's hard. But right now, we're people with with the time to watch the market can set up some short entries here and have probably a decent shot at being right. All right. So do you have any questions about that? There's lots of different supports and resistance, but there's three, I think, that are really critical for you to know. The first are these two moving averages and certain other moving averages that we follow on cheat sheets. The second is what I'd call diagonal resistance. I'm going to just show you that here. This is diagonal resistance, where you connect recent highs and recent lows in the market.
Yep.
So when price bounces off of a kind of a fence, think of it like a fence, that acts as resistance. And when price bounces off a floor, and their floors can be horizontal or diagonal, that's called support. And so the more touches, the stronger the support or resistance, and the longer the time frame. Notice I switched my chart to this. These are weekly candles. So each one of these little bars here represents an entire trading week, not just a day. So the longer term your time frame, the more significant these touches become. They're harder to get through the fence. Think of it that way. So if you're a day trader and you're trading the 5-minute bars, you're going to see a ton of touches. Like I could draw a diagonal line right here, right? You'd probably see 1, 2, 3, 4 touches if I drew this diagonal line, right? So that would be some very, very short-term support. And there's day traders who will take advantage of that and maybe enter here. And they've done quite well, right? Because they anticipated that the market, after breaking this, now this is that 50-day moving average, but you're just seeing it on a 5-minute time frame, that the market reversed and gave them an opportunity to trade what's called counter trend. But again, if you're not a day trader, you're focused on some key time frames, kind of the set it and forget it time frames, then it's the weekly bars and the daily bars that we care most about.
Got it.
Okay. So we want to look at 2 other indexes that are important. And I'd say when you start your trading day, that give yourself a half hour to an hour on maybe once a week to jigger your portfolio, your active portfolio. First thing to do is go look at the market and the direction of the market and make sure you're comfortable with your understanding of where prices are likely to head. So your lacrosse analogy. Okay. And then the 2 other indexes that you should look at on the US side are the Qs, which is the NASDAQ 100.
Yep.
And then the IWM, which is the Russell 2000, the small caps. Okay. So SPY is large, IWM is small, and Qs are tech mostly.
Yep.
Okay. So the Russell has been the strongest index. During this bear market rally, it ripped the hardest to the upside. But like the SPY, look at it, tried to sneak through, but it didn't make it, right? It hit its head and boom. Notice too that it broke out for a day or two.
Yeah.
And then so it fell back down, and then it even retested that 200-day moving average. Didn't quite make it up there. As it, it retested the resistance and it confirmed. So, multiple touches here on that 200-day moving average. It broke past the 50. It's reversing now. This candle suggests that we gapped higher. And because it turned red, it means price opened up here right at the 50-day moving average, that 183.76 point. Do you see that?
Yep.
This blue line.
Yep.
So you'll see price opened there, but then short sellers came in and beat the price back down, right? They put on short trades. Very typical. You can see we opened higher, and look at this. We've already turned negative here.
Yeah. What are short trades?
Short trade is where you're betting, you make money trading to the downside.
Okay.
And I won't get into the technical
trading.
What's that?
Is that what you consider bearish trading? Like
bearish trading, exactly right, and great question. So again, I think for a new trader that's not going to start off by short selling, what this tells you is that you're smart enough to understand that this gap right here, this gap that caused price to go below the 50-day moving average, the rule should be just kind of stay out of the market, right? Because the most probable outcome is this gap will get filled. This little gap will get filled. The old support will be retested as new resistance that will fail and will head lower. So you're using cheat sheets, which we haven't gotten into yet, but I'm going to show you kind of how cheat sheets works in combination with this chart analysis, is basically telling you we are in a downtrend and don't be faked out by these moves, especially if they breach a support level like the 50-day moving average.
Yeah.
Make sense?
Makes sense.
Yep. Okay. So that's the major indexes. And sorry about this. I'm just going to go back to the cheat sheets. I'm going to go back to the PowerPoint so we can make some forward progress here. And I'm going to move us off to the side so we're not in the way. All right. So that's the charts. And let's move forward past the charts and let's start taking a look. Okay. So couple other things that I think are good to do is, and I try to put out the relative strength analysis at least once a week. So I think a weekend homework assignment for traders is always to take a look at the relative strength, whether you have your own system or you subscribe. I try to keep relative strength on the major indexes free. So you'll get every weekend from me free reports on major indexes, on US sectors and subsectors. So it's your ability to assess where the puck is going, or I'm sorry, where the lacrosse, what do you call the ball? Is it a ball? What's the name of the object in play?
Yeah, ball.
The ball. Okay. All right. So this is how you do your where the ball is going analysis. All right. This is called relative strength. We talked about this, I think, the last time we got together.
Yeah, we did.
Yep. And so I'm not going to get into the how to read these cheat sheets, but just say the dollar continues to maintain that persistent strength. We had a little bit of weakness here outside the sweet spot, but it intensified. So we're number one through the sweet spot, multiple time frames of uptrend, and we have a Chaikin money flow that's very bullish above 0.2. So the dollar is very strong. That's very bad for Europe. It means not only does Europe have to exchange euros for more expensive dollars in order to buy energy, right? Because the dollar is the world's reserve currency. So Europe is in a whole lot of trouble here because energy prices are starting to go up again, and the euro versus the dollar, really every major world currency versus the dollar is not doing well. This is actually bearish for the market because the US stock market needs the rest of the world to be prosperous. Because when it's not, it means that those companies that export products to overseas, like Apple, they're not going to be as profitable.
Right.
So when we see strong dollar, we kind of, beat our chest as patriots saying, go USA. But that's actually it's not a great thing to have a persistently strong dollar because it's going to impact everyone. All right, now China, FXI, that's kind of come back from the doldrums, but I'd remind you that China is not rotated into favor into the sweet spot. So we kind of ignore that. We're still in a downtrend across multiple timeframes. They have all sorts of trouble over there. They've got basically their own version of a banking crisis, and the money flow is neutral. So I'm not buying this as this is where the puck is going yet. DBC and DBE, I am concerned about this. So let me explain these ETFs, and they're really important to watch. So these are not stocks. These track commodities. The DBC is a broader commodity, and by commodity, you understand what I mean by commodity?
Yeah.
Like raw materials, energy, and food.
Yep.
So think of the basic staples of life, the building blocks of economic growth are contained in here. About 40% of the DBC is energy. And don't hold me to this. I think 20% is agriculture, and the rest is either in industrial metals and or precious metals. So gold, steel, iron ore, that kind of thing. Some manufactured metals, some not. So it's the broadest look that we've got. And so whenever we see commodities starting to rotate back into favor, not yet again in our sweet spot, right? Commodities rolled over this spring, and a lot of inflation hawks declared victory. They said, nope, looks like inflation's over. Commodity prices have come down. The DBC is underperforming the SPY, at least it was at the time. And so inflation is over. The Fed's going to ease off of the rate tightening cycle, and happy days will be here again. This is not a bear market rally that we're in this summer. Stocks have started a new bull market. That was the prevailing thesis by enough traders, and it turned out to be dead wrong. Mm-hmm. And so what's happened now, and it is the concern, is we're seeing the DBC creep back up here. Remember, I told you relative strength will move before price. And though it's not yet to the sweet spot, so we don't have it at that 3-month level, we are concerned when we see a rotation going 19th, 10th, 4th, 3rd, 3rd. We have to pay attention. Now, there was some weakness, and I blogged about it earlier this week. There was some weakness during a pullback day, I think it was Tuesday, that made me a little less concerned. But the fact is until the relative strength rolls over, we have to keep this in the back of our mind. And money flow, that's the other thing. Our buying pressure gauge is green. So it's suggesting that this rotation is for real, and that unlike stocks, which don't have a whole lot of buying pressure associated with it, in some cases there's a little selling pressure, this commodity rotation could be for real. That means inflation. That means the Fed will keep raising rates, and we could be in for a world of hurt. Now, just below DBC, DBE, that's going to be a smaller sliver of the DBC. So it is the one, this is tied to the futures contracts for energy. And it's U.S. crude oil, Brent crude oil, which is, basically what's harvested overseas in Russia and the EU. And then home heating oil and natural gas. And natural gas is really the big problem here. And for some reason, I don't have natural gas on this cheat sheet. I'm using the DBE sort of as a proxy for all fuels. The fact is that we have a humongo Chaikin money flow. And rotation 29, 7, 2, and 4. Serious, not yet into the sweet spot. And remember that this could be a fake out. But we have to watch this closely. If we creep into the 60-day or better zone with good relative strength rotation, yeah, it's probably a good bullish trade for us. But the world is probably going to be suffering. All right, Asia ex Japan is next. I'm going to start speeding up. That's a lot of China in that.
Really quick.
Yep.
So you kind of want to, when you're looking at this relative strength cheat sheet, you're looking kind of for some of these green squares on the early stages to move into the sweet spot. Is that what
you got it?
For?
Yep. In an ideal world, and let me find one. Let's find one that maybe meets that. Maybe this one, Australia, may be meeting it, although it looks like it's having kind of a shitty week. So unfortunately, it may have collapsed. But we were looking at Australia, which, by the way, their economy is completely tied to commodities, natural resources. They're a big producer of mining, minerals, and fertilizer and other things, nitrogen, phosphate. They were rotating into favor, but there was no money flow to support it. So kind of a fake out here. I would say the best ones to watch are the ones that I just shared with you, the DBE and DBC, although it's early. When they get to here and you see good money flow, you'll notice the trends aren't there yet, but that's sneaking in, that's anticipating, getting open so you can put the ball in the net. Okay.
And this is all for basically bullish trading, right?
Yeah, although we can do the opposite with these. So green to red, where the red starts creeping into the sweet spot is a problem. Right. So bonds. This is the Vanguard World Bond Index ex-US. It was fairly persistent here, and then it rolled over. Now it's had a good week this week, but that might not last. And the money flow is kind of weak. So maybe, again, for short traders are looking for the opposite, right? They're looking for stuff that's breaking down and maybe starting to show weakness in relative strength first before price starts collapsing. IWM and the Qs and the SPY are other examples really early, right? But we want to pay attention because it was Green City up until 2 weeks ago. And we started rolling over, and the idea of the Fed not providing accommodative policy started to seep into market participants' mindset. And as a result, suddenly the relative strength of U.S. index ETFs has plummeted. The NASDAQ in particular leading the way lower. Yeah. But we're still 2 weeks out, right? From a 3 to 6 month sweet spot time frame, relative strength has not yet totally infected things yet, but price has started to move, unfortunately. So we didn't really get much of an edge in this one. But again, the weaker this gets, the longer it gets, the more sustained the downtrend is going to be. All right. So what this will allow you to do is to kind of make a hit list of stuff to watch throughout the week. Then we look at the same set of indexes from a different perspective. Remember, if you just want to keep things simple, you come over here to the tailwind score. I basically give points for each of these. It's a proprietary formulation. Basically, the better you do in multiple time frames with relative strength, buying pressure, the market forecast for oscillators, and the actual trends themselves, those will all combine to give you a tailwind percentage. It can actually end up being slightly better than 100% because bonus points for bullish scores above in the shortest term time frame. So the dollar is the only thing that's bullish right now. This is telling you it's not safe to be in the market for the most part. Even energy has cooled a little bit. And that's what I was talking about earlier this week. These time frames really can tell you a lot. So energy has been rotating into favor. But what's happening is during this pullback, market participants are unloading these ETFs at an outsized rate. The accelerator pedal is not moving bullishly, and the red signals in the shortest term time frames. These are what I call the junior time frames. If you remember from our discussion last week, the fact is that this, you probably from a relative strength standpoint, you would have had these on your radar, but then you would have seen the tailwind scores and the lack of progress in the very short term. And you'd say, okay, maybe this inflation story is off the table. So this data really did counteract that earlier thesis. So the bottom line is we're getting mixed signals right now.
Yeah.
And in bear markets, mixed signals means stay away, right? All the data is basically telling us as bullish traders, this is too risky a time to be in the market, with discretionary trading capital. Okay. Then we're just going to move on a little bit of fast pace. Again, the counter narrative on XLE. This is the ETF that tracks U.S. energy companies. So not commodities, but basically the oil exploration production, the refiners. So think Phillips 66, think ExxonMobil, think of the drillers, the folks that do fracking, all of that combined into XLE. It is the top performing sector in the U.S. It was persistently strong. Commodities rolled over in price earlier this spring. It had been weak. That relative strength is changing. Price momentum in the three time frames and Chaikin money flow. So that's one side of the equation. The other side of the equation is, and earlier this week, the XLE had red lights on. They don't have red lights on anymore. So we'll see. And they have a bullish tailwind. Oh, I'm sorry, that's XLU. XLE, no red lights on the junior time frames, but the tailwind score is under 50. So I'm not sold yet. Mixed signals.
Yeah.
Okay. Here's one that I think is a valid trading signal. XLU. So let's first go back to relative strength. XLU, persistently strong, hasn't weakened. Uptrend in the just not the longest, not the short term right now, but in the intermediate time frame, the 10-day moving average is above the 40, and the 10-week moving average is above the 40-week moving average. Now, money flow isn't spectacular, but it's not negative. This would be what we call neutral plus. 0.05 to 0.1 is weakly bullish. I prefer to see a score of above 0.1, but hey, beggars can't be choosers. So XLU, bullish, minorly bullish from a relative strength standpoint, and pretty bullish. I mean, it's still only at 56, but it gave a short-term trading signal, and that's why I wanted to put it on this list, because it's important for you to know that short-term trading signals can make money where we're just kind of in and out in a few days to maybe a couple of weeks, and that's what this trading signal is, okay? So this is not a buy and hold trading signal. This is, we have enough things on the cheat sheet here. This is the only one that concerns me. We're at a neutral minus on the intermediate market posture, which means that there's a greater chance this trade fails than if this were green. But this short-term entry signal is legit. So let's go to the chart and let me explain to you why. XLU Utilities, by the way, it's a defensive ETF. It pays a dividend of around 3.5%, or at least it did. Price had run quite hard, well above the 50 and the 200-day moving average. And you can see both moving averages are in a bullish orientation, right? The 50, while it's oscillating a little more, it's staying above the 200-day moving average. So even when price comes down, it doesn't stay down for long. It's a little bit volatile, but we had a move where utilities actually broke out of this line, touch here, touch here, touch here, but it didn't hold. We came back down, and however, look at this, the throwback retest, it worked. So here's what's important. When you have a short-term trading signal, you have to have the next time frame up bullish. So remember, the short-term trading signal on cheat sheets is the 10-hour exponential moving average above the 40-hour exponential moving average. The only time to take a trade with that signal is when the 10-day moving average is above the 40-day moving average. So next time frame up must be bullish. Okay. This was my concern. The green line fell. It was very bullish, but it fell below 80, which means that we transitioned from strongly bullish, very bullish, to weakly bearish. Once we crack below 80 and we're pointed lower, the orientation of this fund changes from bullish to slightly bearish. Now, what's happening today, because of this price action, is that green line is curling up. It's also setting up to be confirmed by these two junior timeframe oscillators. So these oscillators, the red line and the blue line, can you see everything?
Yeah.
Did you see my screen, my trading screen, as I just went there? I don't think you did. I remind myself. Here.
Yeah, I was
where it was.
Okay.
Yeah. All right. So let me go back. Sorry about that. So the green line kind of fell out of the bullish zone, but it's trying to curl back up. So I just wanted to orient you. These are the four oscillators that are associated with the market forecast. So on cheat sheets, this red line is factor 10, the shortest term, the momentum time frame. The blue line is factor 9. That's the near term time frame. And the green line is factor 8, the intermediate time frame. And this is factor 7, the long-term time frame. Okay, so long-term time frame is bullish, and actually it's above 50 and moving up. So that gets a bull. Sorry, I'm going back and forth. I know a bullish ranking on our cheat sheet here. So you can see long-term forecast is bullish. The intermediate term forecast is bearish. The only kind of strike against this, however, going back. Sorry, you're going to get seasick. Going back to this, you can see that green line is trying to change. And these two junior timeframes, I'm not going to go back there. They may end today above 80, which would be confirm this move. So all these timeframes relate to one another. At the end of the trading day today, if we see neutral or bullish on these two lower junior timeframes, and we see neutral plus or greater on this one, we already know we have a bullish long-term market forecast. This is probably a legitimate trade. And the other reason that I'm bullish about this will not be on cheat sheets, but it's good for you to know. The intermediate pullback we had was to the 40-day moving average, where the 10 is above the 40. This is not the time frame we're trading, but what happened when we got to the 40-day moving average, this is a bullish candle pattern called a bullish engulfing pattern. So a bullish engulfing pattern occurs when you're in a very short-term downtrend. You're in a bullish overall trend, but you're undergoing a correction, and then at a key support level. And the 40-day moving average, the 40-day exponential moving average, not quite as powerful as the 50, but significant enough that it's really a core part of cheat sheets. The fact that we got a reversal at the 40-day moving average and a bullish engulfing pattern simply means that the prior day candle was bearish, and this candle enveloped the prior day's bearishness. So it means that we opened lower yesterday, and then we traded up all day. So we started out lower than the body of the previous day's candle. This would have been the low price of the previous day. We would have opened lower, and the fact is that we're green, and we closed above it. So we engulfed the prior day's bearish candle. This is a reversal pattern. A bullish engulfing pattern doesn't mean a trend reversal. It just means that if price had been going down, the path of least resistance is for it to go back up toward old resistance. And that's what may be happening today. So the 10 is above the 40, bullish in this time frame. And we had this bullish engulfing pattern yesterday. The market forecast is a little weak. That's the concern. However, the trading signal doesn't depend on the market forecast. It's the, this is the 30-minute bars. What we were interested in is right here. And I think I put that trading signal has within a day or two. So this trading signal actually happened a few days ago this week. But there it is, the 10 crossing above the 40 hour moving average. So maybe the best time to enter would have been here.
Yeah.
So this trading signal, I keep it up for a couple of days. So if it's happened within the past 2 trading days. And so this is a valid entry signal. And let me tell you how you might consider exiting this trade. You have a couple options. The easiest option, but maybe the one that where you give back the most money, is just wait for these moving averages to recross. So you enter when you see a short-term bullish signal. Now, you're not going to get the bearish signal on cheat sheets. You'll have to pay attention on your charts, but you just hold the XLU or the option associated with the XLU, and then you give it back and hopefully take profits if it turns out not to be a whipsaw, what this runs. And you can see here in the other direction, we had quite a run doing that, right? If you traded this bearishly here, meaning you shorted this stock, you were basically in this trade until here, right?
Right.
So you made some decent money. You made 70. Yeah, you made about $2. So, a quick 1 or 1.5% scalp, not outstanding. So here's another way to trade it: is you follow the 40-hour moving average and put a get out line about 1% below your 40-hour moving average. So you're just in the trade as long as it stays above the moving average. And I'll give you an example of how I've set it up here. I've created something. I'm not going to get into this, but it's called a Keltner channel. Basically, it's a little line that shadows the 40, in this case, the 40-day moving average, but I can change this to hours. So basically, I'm in at the crossover point, which I think would have been right here, around 75.40. And I stay in the trade until this price falls below this green line by this much, which is kind of like 1% below the moving average.
It's
called a
the line
channel.
above it.
Yeah, this is your 40. This is the 40-hour moving average. This is what this is.
Okay, but what about there were like 2 lines around it? Like there was one
I
line.
just created an indicator called a Keltner channel, which is just one way to do it. But you can literally just calculate 1% below 74.31, and you just move your stop every day. So you're basically trailing a stop loss below the hourly moving average.
Yeah. Okay. That's cool.
The short-term entry signal is a lot of work for maybe a little reward. So it's not the best signal in the world, but it's important that you know how to trade it. So just keep that in mind.
Okay.
That short-term entries are basically hours. Intermediate term entries are daily charts, and longer term entries are weekly charts. These are going to be the most profitable if they work out. Yep. Meaning weekly. So long term is when the 10-week moving average crosses above the 40-week moving average. It's only valid on Fridays. So keep that in mind, that when you see this signal firing midweek, that the week isn't over until Friday's closing bell, right? Because each candle represents a week of trading. And so the nice thing about this signal is you're going to be in it for a long time, and it's going to be low maintenance. There's always a chance you get stopped out, right? You can get whipsawed. There's no foolproof system in trading, period, that's going to keep you from, where you're guaranteed to make money. So keep that in mind. But in terms of the trades that are going to be more sustainable and lower maintenance, so you're not having to look at your screen every day. Weekly moving average crosses, daily moving average crosses. I love the 10-40 moving average crossovers.
Did you say that's an intermediate term?
Intermediate term. So as you look at this cheat sheet here, you'll see that right now this signal is the short-term entry right there.
Yeah.
Next to it is the intermediate entry signal.
Yep.
And this is the long-term entry signal. So when these fire and saying yes, what this is telling us is that the intermediate signal is telling us this. This is an intermediate entry signal right here. So this is where the 10-day moving average crosses above the 40-day moving average. And you can
You just
see,
switch back over to the.
yeah, we're still, even though this is uncomfortable, we're still in the trade, right? And what we would do is simply draw a little line here.
Oh wait,
1%
Michael,
below.
you're still on the trading signal.
Oh, thank you. Thank you. Keeping me honest. Yep. So
Okay.
1% below this red line here. This is the moving average cross right here. That's an intermediate entry signal. Okay. Now you want all those other things on. You want a bullish tailwind score, right? You want that tailwind score to be green to take this trade. And it would be better to have a few other things working for you. We covered them last week, but just to review, you'd like the green line to be bullish or at least neutral plus. That's the intermediate time frame market forecast oscillator. Cheat sheet factor number 8. You want that to be neutral plus or better. Okay. And the reason for that is because this is the line that forecasts the sustainability of this bullish trend. Does that make sense?
Yep.
Yep. So think of this as the acceleration of this price action. Okay. So when it's pointed up or above 80, it can be in any direction. Pointed up or above 80, it's forecasting in the intermediate time frame continued bullishness. You enter here on the crossover. You draw a line in the sand here, just underneath the 40-day moving average. You, as a trend following trader, which is what this system is, you have to be willing to live through pullbacks like this. Now, if the pullback continues to here, you're out, but still you made some money, right? You probably entered here, you exited here, so you made a couple of bucks, worst case scenario. If you live through this pullback and we bounce and move higher, you're going to make substantially more money. And the long-term entry signal is although you can get whipsawed, as you can see here. But here's the cross. This technically was a cross, and you probably would have gotten out of the trade. But hopefully, you'd have the balls to go right back into it. So we'll call it. This is literally what a whipsaw looks like, and it can be very frustrating to a new trader. You do everything right. You see price come up, and then it pulls back just enough to get these moving averages to kiss each other. Yeah. You're out of the trade because you follow your rules, and you're pissed off, right? Because you entered here and you exited most likely here at a loss, small loss, right? A couple of bucks per share.
Yep.
But it pisses you off. But then on the next Monday, you're back in, right? And if you did that, you're staying in and you're just following that as long as the green is above the red line on the weekly time frame, you can see, I think it brings you closer to your objective, which is you don't have the time to fuck with this shit right now. You're a busy college student, right? Yeah. So the weekly time frame, probably your friend.
Yeah.
The daily time frame, probably your friend, as long as you're willing to check at least a couple of times a week. Right. The hourly time frame, for you, I'd stay away from. Now, something that can help inform a better trend trade on the weeklies is going to be this yellow line here. You want it above 20, pointing up, or above 80. It can go in any direction. If you don't want to put indicators on your line, you just want to, and yes, I'm going back, making you seasick.
That's
again.
Fine, right?
Yep. You just want the long-term indicator to not be bearish. So you'd look at factor 7, right? If you're in the weekly candles, factor 7 needs to be neutral plus or better. Any factor 7 is going to work for you. That's the long-term forecast, okay? And if you're on the daily bars, you want the intermediate forecast, which right now is unfortunately bearish. You'd probably stay away just because it's risky to be neutral plus or better. Okay, neutral minus or worse, more likely that the trade's not going to work out for you. So your time horizon determines what weight you put on the cheat sheet pre-trade checklist. Does that make sense?
Yes.
Yep. So again, rule number 1 must be green, right? Above 50. I don't want to screw around being a hero, trading something directionally that has a under 50 tailwind score. Number 2, these are moving average crossover signals. The weekly 1040 EMA, the daily 1040 EMA, and the hourly 1040 EMA. If you're going to take a trade there, You want a bullish, tailwind score. You want most of the indicators to be green, but maybe the must be greens, or at least not red. The can't be red would be for the long-term signal. You want factor 7, the long-term forecast, to be neutral plus or better. If you're going to take the daily entry signal, which is again the 10-day exponential moving average crossing above the 40-day exponential moving average, you'd like this to be factor 8, the intermediate time frame, to be neutral plus or better. So you just want these to line up.
Makes sense.
Yep, makes sense. And that way you never have to look at a chart. Now, the one other thing that's super important is stay away from any ETF that's flashing a danger zone signal in the near term of the momentum line. Okay, that negates a lot of momentum and trends. Okay, so you don't care about, even if it's saying heads up, that's okay. Heads up is okay. Danger zone, that can really, like anyone trying to be a hero in XLI right now, I try to talk them out of it.
Yeah.
And I've done whole blogs and videos about why, and I think I'd really bog you down to do any more of that. So I got one more round of data, and then I think we'll call it, okay?
Sounds good.
All right. You've taken in a ton, and I'm anxious to see if you decide to trade on paper a little bit to get your feet wet on this.
I feel like now after this session, I could start messing around a little bit with the paper money, like you said.
Perfect. And we need you to come back because there's a ton of other people that are, paying me $5 a month, and I want them to be happy with their results. So you're kind of a proxy for our clients. So your free education in exchange for showing up a few times. I know you're going back into senior year, and it's going to be your appearances will be fewer and far between. But try to come back a couple of times this fall if you can.
I think a weekly thing would be okay. Easy. I have no classes on Fridays, so
perfect. And I don't work on Fridays, so I mean no day job on Fridays. All right, so one more, and then we'll call it. So I'm going to go back to our PowerPoint. Oops. There we go. All right, so I'm going to skip relative strength on sectors, but I do want to point out that XOP, oil exploration and production, that is now creeping into our sweet spot. We're 1 week away. And you can see the price is good, money flow is good. And so companies that are in the oil exploration and production, like ExxonMobil, that could be a decent trade here. And it's a little concerning because this is forecasting that commodity prices may be going up. Right underneath it, this is less liquid, but XES is called oil services. So these are the people that provide the equipment to do drilling. So they supply these people, right? So XES supplies the XOPs companies. Just under them, pharma, Moderna, and Pfizer are about to make a shit ton of money off of yet another booster vaccine that has been authorized by the FDA. And as a result, they're rotating into favor. It just started because we just got approval this week. Pay attention to that. Telecom, this is a defensive play. So imagine people that still have landlines. They're still paying the phone company. It's more than that, but it's, again, a defensive play. When the market goes down, people like this because of yield. And I'll just do two more. KIE is all about, that's insurance. Basically, it acts like insurance companies are like banks. They benefit from higher interest rates. So that's why we're seeing these guys rotate into favor. And it's good to know what's coming. All right. So finally, XOP, no trading signals on our subsectors. But biotech continues to be persistently strong with good bullish or neutral junior timeframes. But the intermediate, we lost the intermediate forecast. So we're waiting for that to turn green. And then we'd look for a buy the dip signal here. And finally, and you can see you're eliminating. The nice thing about cheat sheets is you don't even touch these, right? Just take them off the table. If it's not green, don't mess with it.
Yeah.
All right. So finally, these trade bullishly when we're bearish. And I want to point this out. SH, this is a non-leveraged ETF that goes up $1 when the SPY goes down $1. Okay. It's rotated. We don't have the relative strength for it, but I can tell you the tailwind score is above 50. And we have pretty good indicators here. We got an intermediate term signal. What does that mean? Which time frame am I looking at if I have an intermediate or medium term entry signal?
You're looking at weekly, right?
No, that's long term.
Oh, long term's week.
Yeah,
Oh,
so daily moving average cross. That's what that happened yesterday. 10 above the 40.
Okay.
See that on SH? Let's go
Yep.
there.
Yep.
Okay? And for the final time, I'm going to add to the stream, and then we'll call this meeting. And right now you're seeing XLU, which is, by the way, bouncing nicely this morning. You see that on the weeklies. And so, I'm sorry, what were we trading? It was SH, right?
Yeah.
All right. So SH, actually, I think we're setting up to see a buy the dip signal by the end of today. So we got the moving average cross here. And one of the bad things about a moving average cross is you're tending to buy at a short-term high, right? And then, of course, what happens after a technical breakthrough? We get the throwback retest, right? We'll probably bounce off the 40-day moving average, we hope. But notice here that we were in a bullish uptrend. And then the market spent July and August in an uptrend. So the SH, which remember, up $1 when the market goes down $1, down $1 when the market goes up $1. Moving average cross here, throwback retest, buy the dip signal, very bullish intermediate forecast. Not very bullish, meaning we're above 50. But not yet above 80. So stage 2 bullishness, you'll see that on the cheat sheets. It's the intermediate oscillator or factor number 8 bullish. The junior time frames are pulling back. That's what this is today. And as long as this red line stays above 5, if it stays above 5, the red line stays above 5, but it gets below 10, you'll see a heads up on the cheat sheet I sent out over the weekend. And that's okay. As long as it doesn't say danger zone, that means below 5. So assuming it stays where it's going to stay today, and you really only want to look at these things into the close. As long as this one stays above 5 and this blue line stays above 20, this is a harmless pullback expected to bounce and the trend to continue by the dip signal. So that's all good. There's one thing that maybe we don't like, but I'm okay with it because the market tends to not stay bearish long enough to move this line. So this line is definitely the longer term path of least resistance is lower, but remember, we're trading the intermediate term. As long as I see pre-trade checklist factor 8, neutral plus or better, I'm okay if this is mildly bearish.
Right.
But this looks like a good short entry setting up today. And that's why. And this is short cheat sheets as opposed to bullish cheat sheets. I'm not going to get into these trading signals. This is a whole hour on this stuff here. But I am going to tackle that next time. This is a way to follow a 3-tiered system. So where you're going to enter a bullish trend trade with a third of your capital at each stage of the bullish trend. So it's a way to manage risk. And we'll get into that next time.
Sounds good.
All right. That was a lot of info to digest, but the nice thing is there's a video on stock cheat sheets on Facebook, on the YouTube channel, and on the Twitter account. I think the Twitter account's on the Chaikin user cheat sheet feed. So are we good?
We're good. Yeah. I'm going to start trying
All
to
right.
put that stuff to use on paper money.
Yep. Safe trip back to school, and get in touch with me when you're ready to do another Friday session, and we'll set it up.
Yeah, sounds good. Let's plan on next Friday.
Great. And I'm Mike O'Connor. Cheat Sheets is free. The major indexes, the sectors and the subsectors we put out are free. We do a deep dive into individual stocks. That's a paid service, $5 a month or $50 a year. I say try the free stuff first and get comfortable with it before you start paying me. Make me earn the money. And hopefully between the regular delivery of cheat sheets and then these training sessions, you'll get what you need to be able to make money when the market eventually turns bullish again. Bye for now.